So most people looked at SQM's new 2026 price forecast and saw the same story. Perth strong, Brisbane solid, and Sydney and Melbourne both grinding along. But that's not the real story, because SQM, they haven't just given us one forecast. They've given us 4 completely different versions of 2026. You've got early rate cuts, late rate cuts with sticky inflation, a global slowdown, and even a full economic rebound. And when you line those 4 worlds up, one pattern jumps out straight away. A pattern that almost nobody is talking about. Some cities grow in every single world, and some only move when the conditions are almost perfect. You see, national growth ranges anywhere between 4 and 14%, but the headlines are meaningless. The real signal is actually hidden underneath. Perth is modeling between 12 and 16% in the base case, while Sydney and Melbourne sit in the low to mid single digits. So guys, by the end of this video, you're gonna know what each of SQM's scenarios actually assume, which cities are resilient across all 4 scenarios, and if you stay until the very end, I'll also touch on how I'd position myself for 2026 if you care about risk-adjusted outcomes, not just hype. Guys, my name's Josh, I'm from DataEdge Property, and I help everyday Australians navigate the Australian property market using data. Data that's accessible to absolutely everyone. And if you get value out of today's video, make sure you hit the like button and subscribe so you can continue receiving data-driven updates just like this. And with that said, let's dive straight into why SQM actually built these 4 scenarios. So they certainly didn't build them to be clever. They built them because we're sitting at a genuine policy inflection point. Rates might be cut early or late. Inflation might glide into the low 2%. Or it might get stuck at a more elevated level. The global economy, it might support us, or it could drag us down. And rather than pretend that there's one neat future, SQM has modeled 4 plausible worlds. And the thing that I want you to watch throughout each of these scenarios is, does the story of which cities lead change as we move through these worlds? Or does it stay exactly the same? Because if the order changes, then the trend is cyclical. But if it doesn't, then the trend is structural. And structural trends are where investors build long-term advantage. With that said, let's jump into the first scenario, and that's the base case. This assumes that we have a sluggish but stable economy, inflation drifting into the mid 2%, and 25 to 50 basis points worth of rate cuts in mid 2026. Nationally, SQM expects that under this scenario, we'll see national price growth of between 6 and 10%. And here's the city level spread. So under this scenario, Perth would grow by between 12 and 16%, so another bumper year. Brisbane would follow pretty closely at 10 to 15%, also extremely strong. Darwin, 12 to 16%. Adelaide, 10 to 14%. So we've got the affordable capitals absolutely leading the charge. And then you've got Sydney growing by between 3 and 6%, and Melbourne closely following at 4 to 7%. So even in this easy world, the smaller capitals are forecast to grow by almost double that of Sydney and Melbourne. And that raises the first big question. If the East Coast Giants don't outperform in the easiest scenario, when do they outperform? And the gap, it isn't random. It's the first sign that there's something deeper that might be going on. With that said, let's jump into scenario 2, and this is the grind scenario. It assumes that there's no rate cuts until late 2026. Inflation hovers between 2.7 and 3.2%. We have slower economic momentum across the board. National growth under this scenario would moderate to between 4 and 8%. But the important part, it isn't the national number. It's the fact that the ranking doesn't change. If we look at the individual capital cities, you can still see Perth, Brisbane, Adelaide, and Darwin all charging ahead. Perth would still grow by between 10 and 14%. Brisbane by 8 to 12%. Adelaide 9 to 13%. Darwin, a slight slowdown, but still resoundingly positive growth at between 3 and 7%. Sydney and Melbourne, both similar, 2 to 6%. So this is the scenario that exposes how credit sensitive both Sydney and Melbourne truly are. When borrowing power doesn't improve, their momentum also doesn't improve. Meanwhile, the affordable, supply-tight markets, they just keep moving on. And if the leaderboard doesn't budge in a no interest rate cuts world, well, what does that imply about what might happen when interest rate cuts finally do arrive? Well, make sure you hold on to that question, because scenario 4 is usually where people expect things to flip. And guys, if you're serious about using data to build real wealth through property, make sure you check out my completely free DataEdge property Facebook community in the description box down below. And guys, over 90% of you who are watching this are not subscribed. I'm going to be releasing a video covering a 5th scenario that SQM hasn't even thought of, and it'll be coming out in the coming weeks. So if you want to make sure that you don't miss out on it, make sure you've subscribed. With that said, let's jump straight into scenario 3, and this is the one that normally scares people. It assumes a global slowdown, softer demand, unemployment rising to 5.5%, and 75 to 100 basis points of cuts to cushion the blow. But because the supply shortage is still so extreme, SQM still expects that national dwelling prices would rise by between 6 and 10% under this scenario. And here's the part that you really need to see, and it's when you drill down into the individual cities. So we look at Perth. It still grows by 8 to 12%. Brisbane, 9 to 13%. Adelaide, a whopping 11 to 15%, and that's despite the affordability constraints that we all know that Adelaide has right now. Even Darwin grows by between 6 and 10%. Meanwhile, Melbourne and Sydney lagging behind still at between 4 and 6% and 6 and 10% respectively. So the order, it's identical again. The same leaders, the same laggards, and the exact same gap. So now we can ask the real question. If even a global slowdown doesn't flip the performance order, what would it take for Sydney and Melbourne to actually reclaim their lead? Well, the answer becomes clearer in scenario 4, though it's not what most people expect. But guys, I'm curious to hear from you. What scenario do you think we're heading towards? A base case? A long grind, a slowdown, or a rebound? Make sure you drop your thoughts down below. I read every comment and endeavor to respond to as many of you as I can. And with that said, let's jump into the 4th scenario. And this is the rebound scenario. And it assumes that inflation drops into the low 2%. Unemployment falls back into the low 4s, and rate cuts are spaced out throughout 2026. This is the world where both Sydney and Melbourne should shine, because they're the most rate sensitive markets in the entire country. And they certainly improve under this scenario. Both Sydney and Melbourne would grow by between 7 to 11%. But here's the twist. Even in the best case world, the structural leaders, they still dominate. Under this scenario, Perth would grow by a whopping 17 to 21%. Brisbane and Adelaide would follow closely at between 13 and 18%, and Adelaide even quicker at 14 to 18%, and Darwin would do the same. So even when conditions are perfect, the East Coast capitals, they still don't lead. And if 4 completely different futures all produce the same leaderboard, well, what does that tell you about the next 5 years? Not just 2026. That's the real insight that SQM modeling reveals. But before we dive into that, guys, if you want to see the other side of this, how sentiment, media forecasts, and bank behavior distort these outlooks, make sure you watch my breakdown of Domain's 2026 price forecast right after this. It's linked on screen and in the description box down below. So with that out of the way, what do you actually take from this? Across all 4 scenarios, SQM is basically saying one thing. It's very hard to create a 2026 where prices actually fall. simply because supply levels are so tight. But the real insight is the pattern. The same cities win in every single world. The markets with strong economies, population inflows, and genuine supply shortages. Perth, Brisbane, Adelaide, and parts of Darwin. Now, Sydney and Melbourne, they're still forecast to grow, but unless you're extremely selective, they're unlikely to be the market leaders. Heading into 2026, the data is blunt. The structural story is dominating the cyclical one. So guys, with all of that said, to wrap this up, the key insight, it isn't that Perth will do 16% or Sydney will do 5%. The key insight is that SQM broke the future into 4 completely different pieces. And in every piece, the same pattern showed up. The undersupplied, still affordable markets, they stay in the lead. Meanwhile, the mature, heavily taxed, and more expensive markets, they do fine, but they're far from being in the lead. And if you use these scenarios as a framework, not as a prediction, and ask yourself, how would my portfolio behave in each of these worlds? You will be miles ahead of people who just look at a single digit of growth on the screen and call it a day. Guys, I really appreciate you making it right until the very end of the video. Thanks for watching. If you haven't already, please hit like, subscribe, and I'll see you in the next one.